Economy project. This is the first event of the semester that comes directly out of our canceled but now reconstituted Law and Political Economy, Democracy Beyond Neoliberalism conference. In light of care obligations, time zones, and Zoom fatigue, we decided not to do a 3-day-long Zoom, but instead to break up and transform the conference into a set of resources. And so over the past few months, we've been holding emerging scholars workshops, developing blog symposia, and planning live events from the incredible lineup of scholars who were originally supposed to join us in New Haven last year. We held our first live event from the conference in December on the political economy of inequality, democracy, and oligarchy with Emma Coleman Jordan, Andre Douglas Pond Cummings, Atiba Ellis, Stephen Ramirez, and Gerald Torres. Like all of the events coming out of the conference will be, that event was recorded and is now available on our website, lpeproject.org. In the coming days, there will actually be a new part of the website exclusively dedicated to the events, papers, and blog posts from the conference. In the meantime, you can check out a preview of what we have planned so far and sign up to receive email updates and reminders at the link that I think Raul will put in the chat. We are very excited about what we have in store over the next couple of months. And speaking of, none of which would have been possible without the incredible work of Raul Carrillo and Caroline Parker. So a huge thanks to both of them. Just to give you a very brief preview, our next conference event will be February 8th at 11 a.m. It's on the international law of money. Rowan Gray, John Haskell, Karina Patricio Ferreira Lima, and Nathan Tankus will present work on international law of money's democracy curbing effects under neoliberalism. We will also put a link now in the chat to sign up for that event. One final plug, if you are not familiar with the LPE blog, we highly recommend you check it out. It's also available through our website. Most of tonight's speakers and many others from the conference have contributed there. And now I will hand things over to Tamara Katz to introduce our amazing panel of speakers tonight. Tamara is a first-year law student at Columbia Law and part of the newly established Columbia Law and Political Economy Society. Prior to law school, Tamara worked in democratic politics and as an investment banker, but is now interested in understanding different concentrations of public and private power in the financial system. Thanks again to everyone for coming.
Thanks so much, and it's good to be with you all. So I'll go ahead and introduce everyone. Professor Adam Feibelman is a professor of law at Tulane Law School. His research interests include bankruptcy law, regulation of financial institutions, and legal issues related to sovereign debt and international monetary law. Professor Feibelman's recent scholarship focuses on bankruptcy theory and India's new insolvency and bankruptcy law. Prior to joining Tulane's faculty in 2009, Professor Feibelman was a faculty member at the University of North Carolina School of Law and the University of Cincinnati School of Law. Lev Menand is an academic fellow and lecturer at Columbia Law School. His research focuses on money in banking, central banking, financial regulation, administrative law, separation of powers, and the history of economic thought. Prior to joining academia, Lev served as senior advisor to the Deputy Secretary of the Treasury and senior advisor to the Assistant Secretary for Financial Institutions. Lev has also worked as an economist at the Federal Reserve Bank of New York in the Bank Supervision Group. Professor Salia Morova is a professor of law at Cornell Law School, where she specializes in regulation of financial institutions and markets, banking law, and corporate finance. Prior to joining academia, Professor Morova practiced law in the financial institutions group of Davis, Polk, and Wardwell. Between 2006 and 2007, she served at the U.S. Department of the Treasury as a special advisor for regulatory policy to the Undersecretary for Domestic Finance. Professor Eric Gerding is a professor and a Wolf-Nickel Fellow at Colorado Law. His research interests include securities, banking law, and the regulation of financial markets and products. He is currently working on climate change and financial regulation. He is the author of the book, Law Bubbles and Financial Regulation. Professor Gerding came to Colorado from the University of New Mexico School of Law. Prior to joining academia, he practiced with Cleary, Gottlieb, Steen, and Hamilton in New York and Washington, D.C. And last but not least, Professor Anna Gelpern is an Anne Fleming Research Professor at Georgetown Law and a non-resident senior fellow at the Peter G. Peterson Institute for International Economics. Her research focuses on government debt, contracts, and regulation of financial institutions and markets. Professor Galpern also co-directs the Sovereign Debt Forum, which is dedicated to interdisciplinary research and capacity building in sovereign debt management. And I will go ahead and leave you all in these trustworthy hands.
So Tamar, thank you very much, and Corinne for this wonderful introduction, and thank you to the LPE project for the opportunity to put on this fascinating bunch of papers and to keep trying to figure out what this law and macroeconomics thing might be about. So I will say a couple of words about that and before handing it over to Adam, Lev, and Saleh in that order for 10-minute presentations. If you have clarifying questions, please feel free to put them in the Q&A. We will address them between the two papers, in breaks between papers. After the papers, we will start with a conversation in the panel and then open it up for Q&A in the audience. We will not be monitoring the chat function. We will only be getting questions from the Q&A function. The LPE project team may look after the chat, but if you have a question that you would like addressed, please put it in the Q&A. And then we will have a wrap-up panel conversation. Again, rather than pushing the audience piece to the very end, we thought that we would make sure to get some input from all of you before we wrap up, but then we will have the panel offer some concluding thoughts. So one or two framing thoughts. What on earth is law and macroeconomics? Great question. In some sense, it is an effort to bridge the unbridgeable. So it falls somewhere in between, or maybe with 1 foot in law and economics and 1 foot in the core concerns and methods of LPE. Of course, the law and economics piece is fairly straightforward. After all, both law and economics are part of the title. But the traditional approach of law and economics, of course, focuses on microeconomics and is very much characterized by its discomfort with the role of the state and a certain ideological inflection that may have moderated of late, but is nonetheless a fairly clear thread throughout. Now, the group of folks who've been writing in at the intersection of law and macroeconomics, whether or not they've claimed the label, share with macroeconomists the idea that the state is front and center. It's very much part of the structure of the that's underpinning the phenomena we're describing and the policies with which we're struggling. Good policy is the objective. And that, of course, imports a lot of the core concerns, again, that you see in the LPE conversations, the politics that's embedded in it, the power imbalances, and the focus on justice and equity. But all this to say that what law and macroeconomics have to say to each other and have to do for each other remains very much a work in progress. There have been 3 conferences and a whole volume of law and contemporary problems dedicated to the subject of law and macroeconomics. And here again, I think we can claim some lineage from LPE, which also had a seminal law and contemporary problems volume. But again, this is not really a done deal by any means. Part of our objective here is to discern productive theoretical, methodological approaches to this area, and to find a language that would help us address the things we all care about. With that, I will hand it over to Adam, who will speak for roughly 10 minutes and pass the baton to Lev and Saleh. The focus today is not so much on the kinds of cyclical concerns that animate much of the macroeconomic writing, and particularly the writing in the law and macro space, but rather looking forward to the kinds of institutional structures that law can help describe, build, and the kinds of values that animate them. Professor Feibelman, over to you.
Thanks, Anna. I have some slides that I'm going to share. Can everyone see them? Great. So first of all, thanks so much to the LPE project and for organizing this and including me and us. And thanks to all of my co-panelists. I'm really looking forward to the conversation. So in my brief time, I'm going to very briefly and hopefully quickly kind of brush through my paper in summary fashion and then say a few thoughts at the end, kind of building on Anna's framing to try to situate the paper with the Law and Macro project and hopefully say something at least somewhat controversial for some fun. So the paper, which is, I think, compared to my co-panelists and still much more preliminary stage, is in many respects kind of a friendly critique or extension of Katerina Pistor's work on monetary sovereignty. And by kind of monetary sovereignty, I mean to draw on a literature that focuses on the state's control over its monetary and financial systems as a crucial component of sovereignty in general. And I think it's fair to say there's a conventional view that this element of sovereignty is quite eroded in the contemporary setting. And some of this is through formal actions, joining monetary unions, pegging currencies, and so forth. And much of it is also through informal erosion, exposure to foreign debt, external creditors, cross-border capital flows, and private money creation, both domestically, but also foreign, and then flowing into cross-border transactions. I think that Pistor largely embraces that conventional critique, but I think hers is kind of introduces a more relative view. In other words, some states have monetary sovereignty and some don't. There's a hierarchy among states, there's a center and a periphery. And states that are low in the hierarchy or on the periphery lose important measures of control and autonomy, and especially in times of crisis. There are many great choice quotes from her work, but one will suffice. External help always comes with strings attached and constrains autonomous decision-making. So my project focuses on, it provides kind of a case study that focuses on India and suggests that I think India complicates this account in some respects and hopefully provides an interesting opportunity to assess the kind of overall question of monetary sovereignty. So India has its own currency, but also it has reduced exposure to many of the factors that we think of as eroding monetary sovereignty. So it has significant capital controls, kind of de jure and de facto, a whole bureaucracy devoted to this. The structure of its external debt is interesting in this respect. Much of it is owed to non-resident Indians who have bank accounts in the country, and much of it is in rupees. And significantly, pretty much all of the public debt of India is in rupees, not in foreign currencies. And then kind of the final piece of the analysis is that there's very limited domestic private money creation in the sense that we tend to think of this. then relatively little exposure to these types of instruments by virtue of their capital controls. So the country retains a significant amount of control over domestic monetary and financial systems in both peacetime and crises. And I think this is important. So it maintains its control even, in ways that enable it to kind of maintain an independent monetary policy. And it hasn't needed external help in many decades. Sorry, I'm having trouble. Okay, so I think this helps to understand this, this kind of thinking of this in terms of monetary sovereignty helps understand the country's kind of cautious liberalization and integration as a means for preserving autonomy and a space for democratic governance. But the question I think that's important is what is the cost of doing this? And I think this is another important part of Pistor's work, that there are these trade-offs. And I think the cost may be significant, right? And there are debates domestically and externally over each of these of India's policies. And I think it's important to consider that the possibility and likelihood that there is some impact on financial resources and economic growth. But I do think that it's fair to say that there is, a stable political commitment in the country to the overall approach and a willingness to make these trade-offs for autonomy and control. But the kind of broadest point is that thinking about these trade-offs in terms of sovereignty is a useful and helpful frame. I should say that kind of the next step for me is returning to the Donnie Roderick's work of about a decade ago, who in which he kind of proposes this particular trilemma involving democracy, national sovereignty, and global economic integration. I think these accounts are related, but don't overlap perfectly. So just very briefly, in a minute or so, I wanted, if I have time, Anna, just say a little bit about how I think of this project as a type of law and macro project in a way that maybe makes an argument about the scope of the field. So I think it's fair to say there are kind of two strands currently in the field, or I think of these as two strands. One is that focuses on rules and regimes that have kind of in the aggregate a macro impact, and thinking about the macro economic dynamic or impacts of various types of rules and regimes. But there's another strand that focuses on rules and regimes that are inevitably part of the macroeconomic toolkit. And so, I think it's possible to, and perhaps useful to distinguish between kind of core and potential macro relevant topics. And so core macro relevant kind of regimes would be things like tax, fiscal policy, monetary policy, trade policy, capital flows, external debt, exchange rate policy, and kind of the macroprudential dimensions of financial regulation. These are things that are in many respects actually kind of targeted at the kind of factors that steer the macroeconomy. And these topics are kind of related to or involved in other fields, particularly international economic law and certain strands of law and development. But I think that there's, hopefully an opportunity for these to, if not, play a dominant role in the field of macro law and macroeconomics, at least a robust kind of strand of that focuses on these types of core macro relevant issues. I think in one last thought, in the US and in other large economies, a lot of these, we don't necessarily think of the kind of legal dimensions of these types of policies, but they are legal regimes. and especially in other parts, in other economies, they are critical and very much in flux and contested. So I'll stop there. I hope I haven't gone too far over my time.
That was glorious. That was precisely 10 minutes, my friend. So with many thanks to Adam for that. Lev, the floor is yours. It's interesting, actually, in your typology, Adam, Lev's paper is a very neat fit. Professor Menand.
Thank you, Anna. Thank you also, Tamar and Raul and Corinne and Amy and all the folks at LPE who made this possible. Your efforts not just to get this series of virtual workshops off the ground, but to stand up a whole infrastructure around this set of ideas. They've been really inspiring, and they give me hope that if not this year or next year, in 5 or 10 years, the world's going to look a whole lot different and be a better place. I also want to thank Sally for inviting me to be on this panel and for everything you've done over the past decade to revive this field. I don't know where we'd be if it wasn't for your work, from Quiet Metamorphosis and Merchants of Wall Street and Finance Franchise to the more recent FinTech trilogy. My piece for today is about the banking system and its relationship to the state. It tries to do 3 things. First, it tries to show how the link between money and banking has been steadily obscured over the past half-century by a neoliberal view of money. On the neoliberal view, money is a thing that is out there that banks move around. Once that thing was gold, now it's green pieces of paper. Banks on this view are a type of intermediary. Banks borrow this thing from people who have too much of it and lend it for a price to people who don't have enough. Banking is a commercial activity outside of and prior to the state. The progenitors of this idea, mostly financial economists, they argue that banks, unlike other lenders, are subject to extensive regulation by the state because they are particularly prone to collapse. And their collapse tends to have large negative externalities on other people. The problem is a lot of flighty short-term funding, and that bank creditors are bad at keeping track of what banks are up to. I think this view is flawed, even dangerous. It's responsible in many ways for the practices that brought us the 2008 global financial crisis. The second thing the paper tries to do is recover a money-based theory of banking and explain how that theory has informed American banking law and regulation. The banking system is an outsourcing scheme. Banks are specially chartered by the state to issue money. The money banks issue is called deposits. Although these deposits embed a promise to pay green pieces of paper, they function as money as long as people do not demand performance. And deposits actually comprise most of the money supply, and this is by design. Deposits are how people pay for most of the things they need. They don't use green pieces of paper. Businesses almost never use green pieces of paper to pay for the things they need. And banks create them out of thin air. On this view, money, in particular the dollar, is an accounting device created by the state that is used to direct and coordinate economic activity. It's used to govern. And the green pieces of paper are only a small part of the system. Most of the ledger is maintained by banks. And even more crucially, banks control how big that ledger is. And that banks enjoy this power is no accident. Today's banking laws reflect an explicit compromise about money struck almost 2 centuries ago. I call this compromise in the paper the American Monetary Settlement, or AMS. The legislators who developed AMS thought that the power to expand the money supply was too great a power to leave in the hands of elected bodies, and that doing so would lead to corruption, stagnation, and a debased currency. but they were also afraid to allow the power to concentrate in the hands of a few unelected executives. So they steered a middle course by diffusing the power and constraining it as much as possible. They set up a system of chartered banks whereby anyone willing and able to comply with certain terms and conditions could create money. This system is all about political economy from top to bottom. It has 4 pillars: delegation, privately owned banks, not the government, create the bulk of the money supply; open access, anyone's able to apply for a charter to expand the money supply as long as they can comply with the terms and conditions; separation, the people who get these charters can't engage in commerce and vice versa; and supervision. Special government officials are empowered to stamp out unsound banking and ensure that banks fulfill their public purpose. So the third thing the paper does is integrate this 4th pillar, bank supervision, into administrative law and use this framework to push back on efforts to shift the balance of control over the money supply further into the hands of the franchisees, to take a word from Saleh, who run banks, and out of the hands of the franchisors, the government bodies Congress created to oversee banks on behalf of the public. These efforts are geared toward limiting the discretion and oversight powers of the supervisors. This is the OCC, the Federal Reserve, and the FDIC. And many of the arguments being marshaled have a legal character. They argue that bank oversight is inconsistent with administrative law norms, with transparency, with due process. And these arguments depend on an inaccurate view of what banks do. They treat them as fundamentally private. And what I argue is supervisors are not regulators in the classical sense. They're outsourcers. And banks are not like private businesses. They are a form of pre-modern independent agency. They use private shareholders and managers to avoid monetary overissue and politicized asset allocation by the government. But they're not designed for private shareholder wealth maximization. So supervisors, they don't restrict private liberty, they enhance it by keeping these agencies, these banks, in check. And the paper shows that this institutional arrangement has a long pedigree. It first emerged in New York in the 1830s, following the collapse of an earlier monetary order imported from Britain. And New York invented supervision, this distinct mode of governance that is informal, technocratic, and discretionary. And it did this to diffuse the power to create money into thousands of private hands. During the Civil War, Congress federalized the arrangement. They rejected calls to issue the money supply directly. They created a comptroller of the currency to charter and oversee a system of national banks. This is the system we still have. In 1913, in response to a half century of breakdowns of this system, Congress strengthened the AMS by creating the Federal Reserve. Congress hoped the Fed would coordinate national banks, extend federal oversight to state banks, and prevent panics. This didn't quite work out for a variety of reasons I won't get into. In 1933, Congress again faced calls to nationalize money creation, and again, it chose a middle path, restoring and strengthening the key planks of the original settlement, especially supervision. It created the FDIC to explicitly backstop bank money for the first time and to subject state banks to federal regulation. And it bolstered informal discretionary oversight by authorizing the Fed to remove officers and directors of banks who fail to heed supervisory directives. So the result is a hybrid system where individual lending decisions by banks are a matter of private ordering, but the agencies are empowered to control overall risk levels and fire bankers for unsound practices. And this system, despite its limitations, represented the apex of public control over money in America. And it was left untouched by the procedural revolution of the mid-20th century in the 1940s, when policymakers sought to check excesses in the administrative state. The banking agencies were given a pass. The APA, which was the product of these reform efforts, sidestepped supervision by focusing on formal actions. And Congress continued to strengthen supervisory powers throughout the second half of the 20th century. So The contemporary critics are correct in the sense that federal law locates vast power in the hands of the banking agencies, but they're wrong to think that the exercise of this power is a form of administrative lawmaking restricting private liberty. It's much more like government regulating itself, which in the case of banks includes the private actors the government has recruited to help expand the money supply. And banker complaints about procedural protections and such are an attempt to upset the terms of the agreement that permit them to wield monetary powers in the first place. So I think the conflict over supervision reflects a larger deterioration in the AMS, which has been caused by the collapse of banking law over the last 50 years. And two things have happened. The first is the rise of shadow banks, firms that create deposit substitutes with backing from the central bank, but aren't regulated and supervised like banks. And a big part of that story is international. So the American system is not as sovereign as people think. Foreign firms have gotten into the business of issuing dollar-denominated deposits without a US banking license. And our central bank is committed to backstopping these dollars and incorporating them effectively into our monetary system. The second thing is the erosion of the separation of banking and commerce. Banks now engage in all sorts of activities that were once off limits to them because of their special statal status. And the result is a monetary financial complex where private financial speculation is tied in directly to the state. And that complex feeds financialization of the economy and inequality. As I see it in broad strokes, there are two possible paths forward. There's the path of restoration, which would involve structural intervention to restore the public-private balance from the New Deal era. And this would bring back the AMS, a compromise and a tolerable one, but not necessarily an ideal system. And the second, more robust response would be for the state to take control of money to fundamentally change the role of the public in issuing the money supply. And this would represent something of a vindication of a 19th century public money movement that is largely forgotten today. The Greenback Party, the Populist Party, Alexander Campbell, William Jennings Bryan, Robert Owen. These folks advocated for something different from the AMS. And I've got a proposal with some co-authors about what a step in this direction might look like. But more importantly, Saleh has another. And so I think this is a good place for me to wrap up and pass the baton over to her.
Beautiful. Great transition. Thank you, Liv. So I do want to flag one thing, which is that we did hear two fascinating descriptions of the institutional dimensions of the political compromise underpinning money, and the fact that both papers dealt with elements of that and engaged so richly with both legal theory and core administrative and international law doctrines strikes me as fascinating and productive. So hold that thought, and let's hand it over to Saleh to bring us home with the big vision.
You're muted, Saleh.
Sorry, see, not good with technology. Anyway, I was just thanking everybody at the LPE project for giving us a chance to have this interesting conversation. And it's also quite good to see how our papers are sort of lining up to cue one another in a way that shows already some kind of a natural continuity in this field that's kind of emerging here. So the paper that I'm going to present today is very new, still very much work in progress. It's a complex project. And the idea behind this paper is to try to re-envision, redesign the financial system that we have today in order to connect it more directly to the macroeconomy and make that connection more effective and equitable for everyone. And the purpose behind it, of course, ultimately is to change the public-private power balance in finance, to democratize it on a more systemic level. So the central bank balance sheet, like the Fed's balance sheet, is the crucial lever in this respect, because that is a ledger that effectively mirrors how the economy is being financed. So Lev already walked us through the sort of fundamental notion of the financial system as a public-private franchise arrangement for outsourcing sovereign money creation to privately owned bank. And the one wrinkle that I would like to add to that is that the banks create private deposit money when they extend loans. In other words, that function of money creation is intricately connected to the outsourced function of credit allocation, right? And that's the ultimate source of banks' special power, and that's sort of together makes banks kind of the privileged franchisees of the Fed. So the Fed's balance sheet right now looks like a typical franchisor ledger. In other words, the Fed has absolutely no direct relationship with real economy actors, with regular people like us, or even with corporations that are not banks, not financial institutions. The Fed's liabilities consist of cash, but mostly they consist of bank reserve accounts, which is basically special deposit accounts that are available only to banks. And the assets are primarily US government debt, which means that basically the Fed is channeling its resources into to actors that engage in conducting fiscal policy, and assets that the Fed purchases as a result of rescue efforts, discount window bailouts, and so on and so forth. And we all know the problems with this setup, with this kind of a ledger that the central bank is running today. There are a lot of inefficiencies. For example, whenever there is a need to inject greater amount of credit into the real economy, all the Fed can do is sort of indirectly use its levers to induce private banks to increase their lending, but it ultimately cannot force them to do so. And of course, the Fed rescue efforts during the COVID crisis show that ultimately, in order to step into that void whenever the macroeconomy needs it, the Fed has to take a more proactive allocative role, even without admitting it. So the idea behind the concept of the people's ledger is to change that narrow specialization of the Fed from being just a franchisor that has a direct relationship only with the privileged franchisee banks, to make it a central bank for the economy, for the people, basically to establish the central bank's, the Fed's balance sheet as the ledger that shows how the Fed sits in the center of the real economy, of the American economy, and basically channels the financial resources in the most effective, most efficient, and most public interest-oriented way. And that means redesigning both the asset side and the liability side of the Federal Reserve. So on the liability side, that means that instead of kind of outsourcing money creation to private banks, the Fed as the central bank would directly engage in money creation. And that's sort of a more familiar concept that we already know. There is a lot of conversation about the so-called CBDC, central bank digital currency, which is essentially, it can be along those lines of kind of more direct money creation. And also the more recently popular idea of Fed accounts, the term coined by Lev here and Morgan Riggs, his co-author back in 2018. So that's sort of, that's where my paper is kind of taking off and kind of trying to run with that ball and see how we can push the idea of creating Fed accounts, digital dollar deposit accounts that would be universally available to everybody at the Fed, to kind of push it a little bit to the limit and to imagine what would it be like if instead of being just a public option for deposit banking, this would be actually the full transition. In other words, there will be no more private bank deposit accounts, and all of the deposit accounts will be held directly at the Fed. And there are very interesting implications from that thought experiment, for example, with the much more direct and proactive tools of monetary policy, like helicopter money, which is, considered radical, primarily because economists really do not know how to manage the issue of what will happen in the inflationary environment when the central bank needs to contract the supply of money. How is it politically feasible for the central bank to effectively take money away from people's accounts. And so in this paper, I try to figure out a mechanism that would actually achieve that goal functionally without draining the money permanently from people's accounts. And we'll see if it works, if it doesn't. But the more interesting part of the proposal, and the part of the proposal that, in my view at least, has not been sufficiently addressed in the existing literature, be it economists or be it legal scholars, is what's going to happen on the asset side of the Fed's balance sheet if all of the deposit accounts shift from the private banking sector onto the liability side of the Fed's ledger. So that's the most difficult problem right now, and the economists and central bankers simply ignore it. And they ignore it because it's uncomfortable, because it's not just about sort of the size of the asset side suddenly of the central bank balance sheet kind of exploding, right? But it's a matter of composition. It's a matter of allocative choices. What should we do on the asset side of the central bank with all that money, right? And that's a political economy question, and traditional economists and central bankers are extremely uncomfortable with it. However, I think that it's a unique opportunity to channel capital into productive economic activity in a way that serves the interests of the people. And so in the paper, I go through through three new potential new tools, asset classes that could be put now on the asset side of the Fed's balance sheet instead of just US Treasury bonds or certain asset purchases as a result of crisis rescues. So the first one is the new redesigned discount window. Discount window loans exist today, but right now it's sort of the stigmatized kind of version of last resort kind of liquidity provision for banks that otherwise cannot borrow in the interbank loans market. But now that banks cannot finance themselves through cheap deposits, and they need to kind of find a plentiful and sufficiently affordable source of credit for themselves in order to be able to provide credit to the broader economy, the new discount window can be used by the Fed to extend conditional credit line to private lenders, formerly banks, now just lenders, right, as a tool of directing credit where it's most needed and where it would best serve from the money supply perspective, but also from the broader kind of structural perspective of the economy, the public policy goals. And in that sense, it's the same old tool, but it's used in a more proactive and deliberate manner as a direct tool of credit allocation to the extent that it's not used today. The second type of an asset would be the issuances by green banks, public banks, and by certain public institutions that we currently don't have, but I think we should have, like the National Investment Authority, for example, NIA, financing public infrastructure. In other words, that's your fiscal policy / industrial policy type of instruments. And the Fed could actually channel a lot of its new resources into the sort of purchasing the bonds and other instruments issued by the NIA and by all these other public banks, sort of in the most direct linkage to the macroeconomic objectives. And finally, the third asset class would be market stabilization portfolio of trading assets. Effectively, just sort of the Fed would be able to purchase various financial instruments in the actively trading sort of secondary markets for purposes of preventing kind of excessive bubbles in speculative bubbles in certain assets, and then ultimately preventing the violent kind of busts in those same assets. In effect, that would limit the unproductive leakage of capital away from the real economy. And in that sense, it also kind of links to the macroeconomic health. So just to kind of wrap it up, in the paper, I go through the structural changes to the financial system that this redesigning of the Fed's balance sheet will do. First of all, banks will not be special anymore. They will stop being the privileged franchisees of the government for purposes of money creation, because all the money creation would be basically sovereign. That means there'll be no public subsidy. That's very hard to control or even quantify these days. There will be no incentive for excessive conglomeration and concentration in the financial markets, because We all know that access to public subsidy is the key that drives a lot of that conglomeration. There will be no too big to fail problem, at least to the extent that we have it today. And it will allow to simplify the regulatory structure. The shadow banking sector, in my opinion, will shrink significantly for a variety of the sort of systemic structural reasons that I describe in the paper. And the securities firms will be able to go back to their original function of private risk underwriting and informational arbitrage. So in effect, what the People's Ledger will do is not that it will supplant and drive away all the private financial services, but it will clearly delineate public finance from private finance and will make private finance the space for private risk taking, effectively what private finance pretends to be today, but really is not. And in many ways, it could be a more effective way to accomplish the type of a structural reform in the financial sector that we currently debate under the heading of Glass-Steagall Act and so on and so forth, in a way that sort of works through participatory channels rather than legislation or regulation. So that's basically where I would stop. I hope I didn't go over my time too much.
You guys have been scary good. So thank you. Thank you to all three of our paper presenters. What we're going to do now is we'll go to Professor Gerding, who will first chair a discussion among the panelists and then serve as the voice of the audience from the Q&A. So the first couple of minutes from now on, folks, get your thoughts together and put lots of questions in the Q&A tab. Thank you to those of you who've already put them both in the chat and in the Q&A. We will not be monitoring the chat, especially since Eric is about to talk. With that, Professor Gerding, the floor is yours.
So thank you to everyone at Yale for the event and for creating a framework for real intellectual ferment. I'm going to ask the panelists 4 questions to try to tie the papers together and also tie the papers to some of the questions that many people in the audience work on a regular basis. Question 1, what is the real threat to US monetary sovereignty? So sometimes we hear reactions to calls for the US to restrict private money creation, that this is going to undermine the US dollar as a global reserve currency. What's your response to those claims? Is one response that there's the actual failure to rein in private money creation might be a bigger threat to the dollar and to US monetary sovereignty? At what point do we worry about the Fed's capacity to absorb yet another economic crisis by expanding its balance sheet? Is building a public financial infrastructure a bulwark for monetary sovereignty rather than a threat? Question 2, the transition problem. So in yet another economic crisis, the United States faces another nasty timing problem. We can and should move to more effective financial supervision and building a better public financial infrastructure. But a precarious economy this time and a precarious financial system the last time around poses risks, real and imagined, at least in the short term, for a transition to a better set of rules and to a more public financial infrastructure. But if we wait too long, we lose any real political momentum for change. How do we manage the transition problem with a capital T? Question 3, pulling back the green curtain. So the Federal Reserve and many scholars resist the critique that the 2020 experience underscores just how deeply the Fed has become in credit allocation. How do you respond? And more problematically for our group, is it better to leave the green curtain down? Is it better to have somewhat of a state of ambiguity about the politics of the Fed because of the risk of putting the Fed up for grabs? Senator Paul has a very different set of commitments than many of us might. Fourth, the cross of gold. When we talk about bank supervision and effective regulation being rolled back based on Lev's paper, the work of Saleh and others in the audience, we could see this as the bank sector arrogating to itself a core state function. But that's a pretty abstract threat. Concretely, is it clear who wins and who loses? Can you say more about the distributional consequences? Or is that too vulgar a question, or is it too obvious of an answer? Are there any surprises if we ask the cross of gold question in terms of what's really at stake? What are the other values other than public-private, better allocation of credit, better functioning economy? So those are my 4 questions. I will open it up to whichever one of you would like to say something. Or Anna, would you like to?
I'm happy to jump in, Eric. Those are huge, extremely important questions, and you dropped all 4 of them on us at once. So it's a lot to take on. Maybe I'll try to take a stab at 1 or 2 of them, and then let my colleagues weigh in. On the first question, on overseas dollar funding markets, I think this may be one of the most important and biggest questions for the field of money and banking and financial regulation for the next decade. You really put your finger on, I think, what are some of the key conceptual confusions that have prevented us from moving forward on this question as much as I think we should have since the 2008 crisis, which revealed the enormous size of overseas dollar creation and its vulnerability to classic 19th century style bank panics. I'll take the bait and say that I think the conceptual confusion is that the dollar status as a reserve currency is different and distinct from the creation overseas of dollar denominated deposits and short-term liabilities. And so the dollar as a reserve currency generally refers to the fact that foreign central banks and foreign governments hold reserves of other currencies and assets, and they tend to hold dollar reserves, and they hold those as treasury securities. And so they held a lot of treasury securities, which is a source of demand for US debt. I'll let Anna correct me if I've got the details here wrong. Whereas the overseas funding, that's not the foreign central banks, that's foreign financial institutions. In the 2008 crisis, it was a lot of European financial institutions that were accepting and issuing on the right-hand sides of their balance sheet dollar-denominated deposits without a US bank license to do that. And that business is it's a different thing from the state holding treasury securities. And I'm inclined to say that we can come up with a regulatory regime for the creation of dollars overseas if we're going to tolerate it at all, and vice versa, right? American, US financial institutions could decide to create some other country's currency and deposits. So it would be you could have a mutual agreement about the creation of foreign currencies in your own domestic financial sector that countries agreed to that wouldn't in any way impair the reasons why foreign governments want to hold US Treasury securities as reserves. And in fact, as you suggest, might strengthen the dollar system and reduce the chances of a very severe run in the future not being successfully fought off by the Federal Reserve. And each time the Federal Reserve fights off one of these runs, it has to pour hundreds of billions of dollars into the system in very short period of time. And it encourages the system to grow even larger. And you run the risk that you create a problem that you can't solve next time, and you end up with a very, very severe macroeconomic breakdown. So rather than go on to the other three questions, maybe I'll leave it at that and see if other folks want to jump in on question one.
Also want to push it a little bit to Adam and Saleh. So there are a couple of interesting implications here. I thought it was kind of cool that we had a panel where it turned out that India had way more monetary sovereignty than anybody thought, and the US is sort of complaining about not having enough. But that, begs the question are we trying to create more breaks, more silos, more, in some ways, safe rooms in the system, right? So, I mean, Adam, just to put it crassly, like, should we just do a much better job of capital controls? And then to, both of you guys, I mean, there's the asset side. I mean, even with all the financialization, some of offshore dollar creation goes for, like trade and, real things you can sort of scratch, smell, bite. And taking the analysis in both sides of the balance sheet to that question, and, cross of gold on the asset side is not the answer. So with that, Adam, Saleh.
Well, so I'll jump in just as long as we're talking about monetary sovereignty. Just quickly, yes, I do think that we should, as an international community, do better at managing capital flows. I think, that the conventional wisdom is tending in that direction. I really just want to say a couple of quick things to kind of emphasize a couple of points that I think Lev was making, and maybe add a little bit to it, in kind of noting emphatically that the U.S. Our kind of monetary sovereignty is compromised in all sorts of ways, and I think the example of kind of dollar creation abroad is an excellent one. But there are kind of even more kind of closer to the core, the fact that so much of our debt is held externally. We don't think of that now as a threat of sovereignty, but that is beyond in theory, that's a potential kind of source of constraint. And the fact of being the kind of international reserve currency in the first place is a constraint, right? There are a lot of that requires the U.S. to serve a certain function in creating debt, of a certain amount that enables our currency to be reserved. So in a weird way, that constrains our autonomy. A third kind of quick point on this that would be familiar to folks that kind of follow the IMF and debates there, but in kind of recent years, there was a lot of concern about kind of multilateral obligations, and concerns not so much about maintaining domestic and exchange rate stability, but not doing things that cause instability elsewhere. So, for example, quantitative easing in the U.S. Had the effect of sending a lot of capital abroad, which to other countries that created, vulnerabilities there, which then becomes a concern, for them, but also for us. We don't often think of those consequences here, but they are, and they constrain us as well in our policy making. So there are all sorts of constraints that are kind of unique to the U.S. or to countries that occupy that role. I'll stop there because we haven't touched on three of it.
Yes, I know. Well, Eric and Anna, you pose questions that would probably require a full conference with, I don't know, 10 people speaking and 100 people chiming in. So I would like to kind of quickly address Eric's questions 3 and 4 about the, whether or not it's best to keep the green curtain of mystery kind of around the Fed, and more concretely, who wins, who loses, right? And this kind of reforms, what's at stake here? So part of the reason why, and I completely understand, people are concerned about kind of protecting the Fed and not kind of making it too obvious to everybody that the Fed in reality is not just a neutral Wizard of Oz, right? But it is directly allocating financial resources, particularly in the time of crisis. Part of the reason why we need that is because of that sort of fiction, right? Of that fiction that monetary policy, fiscal policy are completely separate and different. And the fiction that is, in some sense, a corollary for that one, that we don't need anything else other than fiscal policy and monetary policy, but we actually do. And that's the industrial policy bit. So part of this reform is not just changing what the Fed does, but it's changing the ecosystem of public finance institutions that we currently have or don't have. And so some of the pressure that's currently on the Fed to do certain things, and the Fed is the only institution that can do those things, especially in bad times in the economy, because the Fed is the only institution that has its own balance sheet, right? That is fairly independent from Congress. Part of the pressure is because we don't have the rest of that ecosystem. But if we did, perhaps the whole perception of what the Fed does and why the Fed does those things would change. How to get there, that's sort of a very difficult political question. Now, concretely, who wins, who loses, it's sort of, if the Fed, if the Federal Reserve offers Fed accounts to everybody free of charge, right, safe, no nonsense, no, bells and whistles, obviously people who currently don't have access to banking services will be the first to win. That's sort of the most direct kind of financial inclusion effect. And, Lev and Morgan have written about it quite a bit. But indirectly, I think all of us win because of the kind of the changes in the functioning of finance as a public infrastructure, right? In other words, it's a background condition, right? Where capital flows, which sectors, which regions, which firms get investment under what conditions. Those decisions are currently made by private institutions, by banks, by funds, fund managers, and so on and so forth. But if we insert into that process of decision making a public entity that actually will have the balance sheet that will be explicitly geared toward that type of allocation, then we will see how, I don't know, maybe West Virginia will start getting more investment and getting out of the rut that it's in. Not directly because the Fed itself will actually own stakes in companies operating in West Virginia, but because the ecosystem around it will be plugged into the Fed's balance sheet in the right way.
So should I ask a couple questions from the audience? One question from the audience, and I'm going to rephrase it a little bit, Solly, is what about public / state banks? So you've talked a little bit about different functions of banking in different parts of your work, right? Like you've talked about the National Infrastructure Authority and credit allocation and investment. You've talked about payment systems. There's obviously the monetary transmission function of banks that's a core theme for all of the panelists. What if we put all of those three things together? Or is there a political reason to keep them separate, like so that we don't have too much power in one place?
Which three things together? I don't quite know.
All of the different functions that we're talking about, the economic functions of a bank, right? Like what makes a bank special? Like instead of having different public entities, what if we had them all in the same umbrella?
Well,
Too big?
I mean, it's sort of, we have a very complex financial system, right? And in some sense, kind of redesigning the central bank's function as the kind of the ultimate public platform for channeling financial resources into the real economy doesn't mean that absolutely everything, every economic decision or every allocated decision will end up directly in the hands of the Fed. That would be inefficient and it would most likely fail, right? And we don't want it. But and in that sense, for example, various public banks and green banks and climate banks and whatnot at the state level or local level, they don't have to go out of business. We don't have too many of them, but we should probably have more. But they can all kind of fall back on the Federal Reserve's sort of power as the ultimate sort of sovereign, money creator, right? To help them actually fulfill their potential. I mean, that's how I would answer it, but perhaps I misinterpreted the question. Maybe.
So I guess what like there is still a role for smaller public banks, like.
Oh, absolutely. And in fact, it's like sort of the NIA, the National Investment Authority, sort of the industrial policy arm of the government we currently don't have, would ideally specifically work with public banks and state level public financial institutions and investment institutions to help them get off the ground and fulfill their functions. Absolutely.
So the next question.
Can I jump in on that? Sal, I took you to be saying, though, that at least the money creation power of banks would, under your proposal, that would be taken away. And so you sort of proposed something like, the way I was thinking about it is single payer for money and deposits, right? There's a question of how are we going to make money more public, and one option is sort of a single payer on money, and the Fed would be the single payer. And public banks, the movement right now in California and New York and Massachusetts, this is a sort of a public option approach where you still have private providers of money, but you're going to have public providers of money. Is that fair?
I mean, it is, except, I don't know. I mean, my view of this sort of the current movement toward public banking is that it's only in part about providing deposit services, right, and access to banking. A lot of it is about what happens on the asset side. In other words, to stimulate the local economies to channel the money exactly where it's needed. And that's the function that is valuable, and that's the function that we need to kind of support. Those public banks in California, whatnot, they're not necessarily issuing, at least I'm not aware of, like their own California dollar, right, rather than the US dollar in a sense. There could be a token that's sort of kind of tied to the US dollar ultimately, but I don't think of them as they currently stand as necessarily money creation competitors to the Fed in that sense.
But when the Bank of North Dakota,
it's a bank.
Extends a loan, it expands its balance sheet, it issues new deposits, it creates money, it acts in much the same way as your JP Morgan or your Bank of America. But I take what you'd be saying is that the part of the mission of the public banks, which is the credit side, which is like mini NIAs, that we would still want to pursue, and it's consistent with a reframing with the people's ledger.
Yeah.
So you guys,
I also just, sorry, I want to make sure that we touch on Amy's question from the chat box from way back, which I think was also sort of Eric's part 4. And I know, Sally, said a few words about it, but just in terms of the distributional consequences of why all of this matters. One way to sort of get into this is just to go back to the debates in Congress in 1913 when they created the Federal Reserve Act. And because there's a real question about where is credit going to be allocated. When you have the money creation power, money is issued to purchase some financial assets. And the question is, what financial assets can be purchased with money? And there was a big fight over whether whether agricultural land could be used to borrow against with the creation of new deposit money, or short-term commercial paper, which is how the Federal Reserve was designed. And there was a desire to avoid financial speculation, call loans. And there's a great paper about this by Nadav, who is one of Eric's colleagues at the University of Colorado. And so the distributional consequences are all about where is this special ability to create money? What is being used? How is the money being put into circulation? Because that's a privilege and a benefit that's directing activity in that way. And who has that?
Let's shift this a little bit to who decides, right? Because a lot of this is not so much about, and it certainly is about the, what assets to buy. But look, in theory, the Fed could go out tomorrow and buy only, green stuff. I mean, heck, it can go out tomorrow and buy zucchini, right? But the institutional design we have presupposes something different. I'm glad you cited to Nadav's paper, Lev, but what I'd love to hear from all of you guys, and certainly, Sally, because of the kind of the breadth of the project, and Adam, I think there's some interesting questions for you in the queue as well. How modular are your visions? In other words, and one way to think about what we've been talking about is, we've kind of given up on or given away the separation element in, Lev's kind of four-part structure. Maybe, if we can take back delegation, but what if we just limit open access, right? So, I mean, how, can we take the asset side without fully nationalizing the liability side, right? I mean, that's in some ways the public banks question. And going back to Adam, I mean, sort of how, in some sense, you have the, one of the questions for you is, well, if the periphery is pretty much a victim of the kind of center's countercyclical policies, right? Like, it's all nice for you to talk about monetary sovereignty, but, they're sort of blank out of luck. But you seem to be presupposing a good enough capital controls arrangement, right? So kind of this question of modularity and how much you can wall off certain elements of the design is something that I find super interesting. Pause, hand over.
Well, I'm happy just to address that last part. And I wrote something by way of answer in the Q&A, but I wrote it while I was listening to Saleh, so it is with half of my brain. But so, I mean, I think it's definitely true. I don't mean to suggest that the kind of degrees of sovereignty are equivalent. And actually, part of what I'm trying to suggest is there is kind of a spectrum and degrees, just that it's entirely possible. And I think I found, an example of a state that has more sovereignty than we might imagine. And so, and I'm trying to be careful not to suggest that this is to make a judgment about whether this is a path that should be followed, but that it is effective on some level. But it's certainly true that kind of states that are not in the core are subject to decisions that are made at the core, which is a limitation on their ability to act. But there are all sorts of ways that those states can accommodate the global monetary and financial system in ways that kind of limit their vulnerability to it and their ability to kind of continue to have some real autonomy in their own domestic monetary policy and control over their financial system. And I don't know what the number of that subset is, but at least there is a model. But I think it's, there are costs and trade-offs to that. So it may be a stable model for now, but it's being tested and will be tested in the future.
Solid.
Well, that's an interesting question. I think you're right. There is a significant degree of modularity in a proposal like the People's Ledger. In other words, we can do on the asset side pretty much most of what I propose without switching entirely to public provision of deposit accounts. Even if we don't even change anything, we could still set up an NIA, and I'm hoping we will. I don't know, fingers crossed. We could definitely do the OMO plus type market stabilization trading by the Fed for purposes of keeping the financial markets from overheating unnecessarily in a speculative frenzy of some sort. All of that can be done even without switching to Fed accounts. The thing about it though is like most of the conversation is happening about the change on the liability side, right? For purpose of financial inclusion or fast payments and efficiency or digitization of those payments and whatnot. And part of the idea behind this project is kind of once you start really engaging with what that means, right? Then you have to face the questions of the qualitative composition of the asset side of the balance sheet. And you have to ask yourself, what are the real risks of not going far enough, even on the liability side? In other words, if we do just a public option, what does that mean? Are we risking kind of upsetting the current settlement, right? The current franchise, however kind of publicly suboptimal it may be, are we likely to make it worse, trying to make it a little bit better in terms of direct access for certain unbanked people to deposit accounts? Are we going to, somehow increase the instability and increase the possibility of banks effectively, taking in more private rents from this newly recreated pot? And I don't have complete answers to everything. And, I really appreciate this sort of conversation. And, I'm sure that we're all working on a variety of issues related to that. But that sort of was the kind of the thought experiment part of this project.
So I think this is maybe last call for, Eric, what do you think? Last call for questions?
Ask now or forever hold your peace.
Yeah, or hold your peace until the next Zoom session. And maybe we can, I do want to push a little bit on takeaways for law and macroeconomics in particular. I certainly think that by any standard, right? We've talked about money, we've talked about, central bank design, we've talked about kind of stimulus and stabilization. So we're good on box checking, right? But whether in fact legal analysis and legal design and sort of legal theory has something to say on the subject of macroeconomic policy and whether and how might it say so effectively. And, what we as law scholars and practitioners take from macroeconomists, or, we can just talk about the same topics in parallel and, be happy. Question mark. Not just a question asker, sir.
No, I think you should actually express your opinion on this matter. No?
Who, me? Oh, well, look, I think it's interesting. I think that I am most intrigued by this is why I think it's a bottom-up work in progress, right? And that's why in some ways I see a lot in work that doesn't claim the kind of law and macro kind of overall label, right? So, I mean, look, my favorite paper ever remains David Super's Fiscal Federalism paper from 2005, right? Which kind of was published between the two law and macro moments in law reviews. So I think the engagement with administrative law is fascinating in Jeff's paper, right? So I think that the fact that, so the way I read your paper, Lev, is to say that the administrative law treatment of bank regulation today kind of misses its fundamental constitutional essence, right? And in fact, it sort of misdescribes the bargain and therefore misapplies, mistheorizes, sort of misuses, I guess, the law. And so, and that of course makes me wonder, well, so maybe we're in a project of reimagining administrative law then, right? And in particular, but, you know, just as an asterisk, I mean, I'm not sure, like supervision is sort of a tricky case for that, right? Because for some of the same reasons that, you know, modern monetary theory is a tricky thing, right? It sort of stipulates that something is on the inside that claims to be on the outside and then proceeds from there. I mean, ditto for, you know, Adam, the richness of your institutional description of monetary sovereignty, I think is, tells me there's potential in law and macroeconomics, right? That, I mean, in some ways, these are all micro foundations papers. So like my little loopy view is that law is the real micro foundations, right? There is no micro foundations, it's just law. So sort of macro operates within legal political structures. And like we're the ones moving the levers. So that's kind of my 2 cents, Saule, and that's why, you know, what you're putting forward is an entire apparatus. It's not like a lever that cranks out, you know, money or, you know, fiscal policy. It's the gestalt. So in that sense, it's very legal and constitutional.
Can I second what you're saying, Anna? Like, I think what I like about these three papers is there's another view of law and macroeconomics that I find a little bit impoverished, right? Which looks at law as a tax, right? Something that we either like ramp up or ramp down. And what I like about each one of these three papers is they are very much bottom up, and they're very much about a very different conception of the relationship between these two fields, right? Which is law as infrastructure, right? Like law as constitutive, to use some of our other colleagues' language, right? And I think that's I think where we have our most promise, and where if you talk about neoliberal ideas, right? Like law as tax is a pretty neoliberal idea.
So I completely agree with Anna's characterization of my paper, and I would just add that I think that you're right to say both that there's something more to be said about what's going on in administrative law here, and that in saying that we have to be careful not to overgeneralize from the example of money. Money is a very unusual form of governance that the state has long involved private actors in, and has created lots of unusual institutional apparatus in order to produce in a way that works politically and also economically, and sometimes it doesn't work very well. And these are challenges that we have yet to achieve, I think, a good resolution to. I think Saule and I think that the balance needs to be shifted back more towards the public, but extrapolating from that to a whole theory of administrative law, there's a challenge there. That being said, I think just to say a word on administrative law, there's been a neoliberalization of administrative law over the past 20 or 30 years, and the form that has taken, at least one of the forms that it has taken, has been the rise of a monistic view of administrative agencies. All administrative agencies are the same. The president should be able to control all of them. The courts should apply the same judicial doctrines to interpreting them. And there's no effort to appreciate diversity in administrative forms. The reality is a pluralist picture of administrative agencies. Bank regulators and banks are one example of this, but if you look at the history of the US Congress and the federal agencies, they're all created to solve different problems in different ways. And they expect different procedures and they have different institutional structures. And I think that, and this is sort of orthogonal to our point, but important to understanding money is to recapture that diversity in the space of money. And it probably is needed in other areas as well that I don't know as much about.
Yeah, I don't know if we're out of time.
Speak.
So, but just to follow up on exactly that, and maybe to go back and because Amy in the chat had asked a question and Lev had responded a little bit, but it's a really, I think important critical set of questions of, what are the stakes of thinking about the political economy of money. And I think the discussion has indicated that in many respects, it's kind of all of the above. And that, I think there's been a lot of really important work, including by Saleh and Leb, on how we should think of banking regulation, financial regulation as part of the legal infrastructure of money. But what I've been kind of focused on is how what that broader range of the legal infrastructure is. Especially in countries, again, that we might describe as on the periphery, where things like exchange rate policy and regulation of capital flows are kind of critically important, both to the kind of managing of the monetary system, but also, having kind of steering effects for stakeholders with important implications for growth, but also distributive factors and kind of democratic control of the economy.
Okay. Well, folks, we are 2 minutes over time. I'm not sure if we all turn into pumpkins, but thank you to the LPE project team for organizing this and giving us this opportunity. Thank you for Saleh for bringing us together and keeping us on task. Thank you to Eric for keeping us alive. And thank you, of course, to our fabulous panelists and to the audience for enriching our thinking in this exciting new space. Let's go change the world. Have a nice evening.
And thank you, Anna. Thank you to Anna, of course. Thank you, guys.
Thanks to all.
Bye, everybody.